Ladies and gentlemen, welcome to the second lecture of FX Pioneers Trading Institute. We are still on the beginners, which is the foundation, and we'll be talking about, we'll be continuing on our foundation course, which is a 4-part series, and this is lecture 2. Welcome back. Like always, you need to make a pause, then read the disclaimer, and also read the CFTC rule 4.41. And okay. Those are the guys, two guys that are there, like as always, bulls and the bears. This is the type of a market we are in. We are in the market of bulls and bears. The bull with larger muscles and the bear with big muscles as well. They are in the market. They are in the foreign exchange market. And okay. This is what you will be learning for this lecture too. I think that the first one is being covered in the previous lecture, and this is what we'll be talking about. We'll be talking about what causes people to lose in the foreign exchange market. We'll be talking about what is interbank, what is Forex account, who gives an opportunity for you to trade, and we'll be talking deeper into what is a broker and its duties, and we'll be talking about different types of a broker. All right, okay. Moving on, we'll pass on this one. So we'll talk about what actually makes people to lose in the foreign exchange market. What makes people to lose? Lack of knowledge. You cannot just bump into the foreign exchange market and expect to make money. You need to have a lot of knowledge as to what you're doing. Let me make you an example in the real world. You cannot just conduct any type of a business or any investment without having a knowledge of as to what it is that you're really doing. You need to have a full understanding of what you're doing. Hence why you need to have knowledge. Having lack of knowledge will cause you to lose in the foreign exchange market. And many people overtrading, making too many trades while it's not necessary will make you to lose your account. You will have severe losses in your trading account. Okay, you don't need to over trade because you will lose a lot of money. We are trading with our own money. If we are trading with our own money, we are not here to play with our own money. If you are trading with your own money, you would understand that is the type of money that you are using to do a lot of your needs, to fulfill your needs, to fulfill your family's needs. So you cannot just gamble with the money of your family or the money that you will use to support your family or yourself or your wife or your kids. I don't know whether you have kids or not, but I'm saying that this is the money that you will use to meet a lot of your needs. So if this is the money that you will use to meet a lot of your needs, you need to treat trading or your money like a bubble. If you blow your bubble, guess what? You have nothing left. So You do not need to be over trading. So people over trade and they make too many trades and then they lose in the foreign exchange market. This is why many people lose in the foreign exchange market. The foreign exchange market have a high risk, and they will make too many trades without having a proper strategy. They take high risk trades without having a proper strategy. That is very wrong. That is why many people lose in the foreign exchange market. And trading is emotional. It's based on fear and greed. So anything that gives you a lot of emotions can actually be very tough, or can give you a lot of tough time in order for you to make profit from. So many people involve a lot of emotions, and having a lot of emotions causes to have fear and greed, and fear and greed is the prime reason why many people lose in trading. You should take away your fear. You should take away your greed. You need to implement discipline in order for you to trade. If you are fearful, if you have a lot of fear, you will never take a trade, or you will close a trade too early. And this is the type of behaviors that we don't need. You need to let your winning trades to run, and you need to monitor them. You need to protect the profits that you have already made. You need to understand putting stop loss to break even, things like that. You don't need to be that greedy. You need to have distinct targets where you need to be taking your profits, and you need to have distinct areas where you shouldn't be trading while in loss, further than that type of area or that area of price. You know, you see, this is how you can avoid losing. So many people lose because they involve a lot of emotions, which is fear and greed, and then they end up losing. Even their winning trades end up losing, which is not anything that you're looking for. Many people, again, they do not have a trading plan to follow in place. So if you are just doing business, you don't have any type of plan to follow, is that business gonna succeed? Most of the time, 9 out of 10, or 9.99%, 9.99 out of 10, that type of a business will fail. You need to have a plan. Hence why in trading you need to have a trading plan. And also, you cannot trade without using or implementing risk. You need to understand risk. You need to understand the risk part of trading, so that you would understand how to stay in this type of a business. Because if you do not implement any risk, you will lose all your money. You will lose all your money, because trading is risky. Hence why you need to implement the risk part of it. This is why you need to use proper risk management. So not using proper risk management will make you to lose in the foreign exchange market. Again, they do not put a stop loss. You need to have a protection. You need to have a a fallback plan. If ever the market is not going in your direction, it needs to be stopped by what we call a stop loss. We need to stop our losses. We need to limit our losses using a stop loss, failing which you will lose the entire funds. You rather lose a certain portion and having market to stop you at a certain price, and having a certain amount of money still left in your account that gives you the opportunity to take on the next opportunity that presents itself in the market, and then you can make whatever you have lost and make it back and extra. So you need to put a stop loss. So not putting a stop loss will make you lose in the foreign exchange market. And people are not keeping track of running trades. Many people are not keeping track of running trades. Somebody will take a trade, and then the trade goes into profit, and then it goes back into losses because they haven't even put the stop loss at break even, or they don't even have put the stop loss in place, which is bullshit. You need to put stop loss, and this is how you will protect your running trades, or you will protect yourself from losing trades. So you need to have a stop loss in place. You need to keep track of your running trades. You need to monitor them so that you will be in the position to take the profits that you are making and put them in your bag and protect your running trades. This is why many people lose in the foreign exchange market. They lose for these such type of things, not putting stop loss, not monitoring their trades, and again, most of the people won't be trading in line with the market makers. You see, the market is controlled by the market makers, which are the big players. So you need to align yourself with the market makers. You need to see what they are doing. You need to see how they are trading the market in the current using the current price. You need to trade in line with them. You cannot trade against them because they move the market. Maybe, for example, they move the market lower and then you are buying. Guess what? The market is going to be moved lower. The price is going to be going lower. And you buying doesn't indicate that the market will move where you have predicted the market to move. You need to see the bigger picture. You need to see what the market makers are doing so that you can have a clue that the market will be going in this direction next. You make your predictions based on how the market makers are moving the price. That's how you win. So failing to trade in line with the market makers will make you to lose a lot of money. And again, you need to manage your emotions. You need to be emotionless when trading. Of course, the price will scare you here and there, but having done a lot of homework, having done a lot of research, and taking hours and hours evaluating the market and validating your strategy, backtesting your strategy will make you to be less emotional. And when you are less emotional, you can execute trades, and you can execute at the price points that could be scary, but you knowing that this is a good place for me to place a trade, and therefore you will most of the time win, but not all the time. Let's bear that in mind. But you not managing your emotions will cause you to go into a collapse. So again, most of the people, they hold long on the losses or on the trades that are losing. You don't need to be holding for a long period of time for the trades that are losing. You want to hold long for the trades that are winning. But again, let's not forget that you need to be managing those running trades. So for a losing trade, you need to lose less, you need to make more. So losing less means that you won't be holding long, because if you're holding long on the losing trades, the trade will go more and more into losses, will make bigger losses, and hence why your account will end up blowing. You will end up having nothing in your trading account for you to trade with when the next opportunity presents itself. So you need to be in the position, or you need to train your mind not to hold so much long on the losing trades. Hence why you need to have stop loss in place so that it limits your losses when the price gets to a certain price point. The market stops you out when the market hits your stop loss. And your stop loss has to be very strict. This is what we'll be talking about in the BTMM full course. Okay. Again, not knowing the psychology of a price will make you to lose. You will lose when you do not have any understanding on the psychology of price. You need to understand the psychology of price. You need to understand how the price is moved and why the price is moved in such manner, in such direction. Why is it moved most definitely like a routine? You need to understand why. If you do not understand that, most definitely you will be gambling and you will lose. You will win once in a while and you will lose most of the time, which is not what we are doing. Trading is based on the analysis. So if the trading is based on the analysis, it means that you need to learn how to analyze for you to most definitely win almost every time. Since we know for sure that you won't win every time, but most of the time you need to win. So you need to learn the psychology of the price. And most definitely, most people are not treating trading like a business. They don't treat Forex like a business. They treat it like gambling. Hence why they lose, because they come to Forex trading to gamble, and hence why they lose. Guess what? They will lose more and more and more, because this is not gambling, it's trading. They fail to treat it like a business. You know, a business, you need to nurture your business, you need to grow your business, you need to implement risk mechanisms in place in order for your business to survive. You need to mold your business, you need to shape your business, you need to add some innovations in your business. This is exactly what you need to do in trading. In order for you to be a profitable trader, you need a profitable trader. You need to treat it like a business. You need to treat it like a baby. You need to grow it. You need to nurture it. You need to make it to reach to a certain level. You need to make it something that will always be there for you to generate money with. Hence why you need to treat it like a business. That is typically how a business is. So if you're not treating it like a business, you won't succeed in a trading business. You need to understand how the business is run and run it like a business. And again, uh, many people think that trading or forex is a get rich quick scheme, which is wrong. You're not gonna get rich through a night. You're not gonna get rich through a day. Yes, of course, when you have a certain amount of skill and having practice and having done it mostly on your real account, then you can make cash quick. But you can only make cash quick when you have a lot amounts of knowledge and practice and experience. So if you don't have lots amounts of knowledge and experience, you will make money today, lots of it, and lose it tomorrow. That's not what we want. We want to acquire money, we want to keep the money, we want to grow the money. So therefore, we cannot make money and lose it all. Hence why we said that many people are not putting stop loss, they are not managing their running trades. So you need to do that in order for you to win. And you need to understand that it's not a get rich quick scheme. Hence why people lose in the foreign exchange market. They think it's a get rich quick scheme, which is wrong. And again, most of the people, they do not refresh their minds before going to the charts. You need to make some form of refreshments. You need to have a stable mind while going to the market, because the market will humble you so bad if you do not have a stable mind. You need to have a stable mind. You need to have your mind in a proper condition. If you do not put your mind in a proper condition, you will make silly mistakes. You will make very minor mistakes or big mistakes and end up losing a lot of money, which is not the type of thing that we are looking for. As we said, we are looking to acquire money, we are looking to grow money, we are looking to sustain the money, retain the money, to keep it. We are looking forward to grow it. This is an investment. So we don't play with our investment. We don't play games with our investment. So hence why you need to put your mind in the correct state before going to the charts. Many people lose because of this. She's heartbroken, he's not feeling well, he is this depressed, then he goes to the charts like that. You need to freshen up your mind, keep it fresh, then you go to the market, and this will allow you to make proper decisions in a trading business. Okay, moving on, we will talk about what is actually we are talking about when you talk about interbank. The interbank is actually a network used by the big financial institutions to trade currencies and other currency related derivatives directly between themselves. This means banks use interbank to manage their own exchange rate and interest rate risk. Interbank is actually the combination of the biggest banks or central banks that control the price, they control the interest rates, they control the exchange rate, they control the price of the currencies. This is actually what we call the interbank. It's the network of those big financial institutions, and they form what we call an interbank, and they also control the derivatives. They also control what we call derivatives. Okay. What actually are we talking about when we talk about the Forex account? This is an account that is like any other form of account that you know. Since you are aware that any account mostly is open to save certain information about something or someone. E.g., you have the fellow Facebook account, um, Instagram account, email account. We have different types of account, but the difference is that this type of an account is the account that is intended to keep your personal funds and your information pertaining that personal account. You have a personal account, and this personal account will keep your own personal funds. It will keep your funds, the funds that you will be using in order for you to trade. This means that the Forex account will keep your money that you will use in order for you to be trading in the foreign exchange market. And who gives you this trading account? Who gives you opportunity for you to open this trading account? We have what we call a broker or brokerage company. This is the middleman between us as retail traders and the interbank market. So we cannot interact directly with the interbank market because we don't have huge sums of money like big institutions do. Hence why we are not part of interbank. So broker gives us the ability to interact with the interbank. They give us the privilege to open an account through certain broker or the brokerage firm. That's what you may call it. In order for us to access interbank, to access it in terms of passing our buy or sell orders or limit orders or any type of orders to the interbank. So this means that brokers are the ones that offer trading accounts for retail traders, which is us, which is me and you. So in order for you to trade in a foreign exchange market, you need to have a broker, and this broker will allow you or allow your trades to be executed in the interbank market. They are just middlemen between you or us and interbank. When you place a trade, they simply pass it to the interbank market, and interbank executes that trade. The trade or our trades are executed within a very short period of time, within split seconds. They need to be executed within split seconds. Hence why you need to understand the types of brokers and understand what you have to choose as a type of a broker that you will be dealing with for your funds or for holding your funds, so that you cannot encounter any of the problems. So let's talk about different types of brokers. Talking about different types of brokers, we talked about the fact that the broker is an individual or a company that buys and sell orders according to the trader's orders or decisions. So brokers can earn money by charging spreads or what we call commissions. On the trades that you make, they charge spread, what we call spread, or commission. And they may also charge other fees for their services. Retail forex brokers make it easy for us as retail traders to trade in the foreign exchange market by offering us opportunity to open accounts with them and executing our trades or the so-called decisions on the behalf of us, passing them to the interbank for them to be executed. So we have different types of brokers. We have what we call market maker brokers. We have what we also call electronic communication networks, which is ECNs. So market maker brokers, as their name suggests, they make or set their own bid or ask price themselves. We have what we call a bid price. We have what we call an ask price. This is actually what makes what we call a spread. So they set their own spread. Market maker brokers, they set their own spread, while electronic communication networks, which are ECNs, they use the best bid and ask prices available to them from different institutions on their interbank. They use the spread of the interbank, usually ECNs. This is what simply is meant here. Okay. So you should say that market makers are the fundamental building blocks of the foreign exchange market. Retail market makers basically provide liquidity, repackaging large contract sizes from wholesalers into bite-sized places. Without them, it will be very hard for average person to trade forex. So brokers, like we said, they set their own retail prices, meaning that they set their own spreads. While electronic communication brokers, which are called ECNs, they match customer buy or sell orders at stated price. These stated prices are gathered from different market makers, banks, and even other traders who use the ECNs. Whenever a certain sell or buy order is made, it is matched up to the best bid or ask price out there. Due to the ability of traders to set their own prices, ECN brokers typically charge a very small commission for the trades you take. The combination of tight spreads and small commissions usually make transaction cost cheaper on ECN brokers. They also charge the spread. These ECN brokers, they also charge the spread, but their spreads and commissions are very, very low as compared to the market maker brokers. They are very, very low. So these are the types of brokers that we are will be dealing with on our most of our trading journey. We'll be dealing with either market maker brokers or ECN brokers, which is electronic communication network brokers. But I recommend ECN brokers because their spreads are very low and their commissions are very low as well. So I only use ECN brokers, not I will never ever use a market maker broker. So that is pretty much it for the lecture 2. Thank you for watching. Stay tuned for the next lecture, which is lecture 3.